Hello students, today I am going to discuss with you generally accepted accounting principles. These principles or concepts have been developed by the accounting profession over a period of time. These principles or concepts help the financial statements to be reliable and comparable, because if every firm in the industry follows these rules or these principles while preparing their financial statements, then those statements will be reliable. Why I say reliable? Because if you are consistently following the same policies every year, then naturally your statements become more reliable, right? For example, if in a particular year you evaluate your inventory in a particular manner, and in the next year you change the method of evaluation of your inventory, now it will have an effect on the calculation of profit. Okay. Now if you keep on changing these practices, then how can your financial statements be reliable? Okay. So to make the financial statements reliable, we must follow these rules. Okay. Now if every firm in the industry follows these rules, then all the statements prepared by them will be comparable. That means the statements of firm A will be comparable with statements of firm B only and only if both the firms are following these rules while preparing their financial statements. And if they are not doing so, then their financial statements cannot be compared. Not only that, if you keep on changing the policies, accounting policies, then even your own statements cannot be compared with statements of previous year or before that also. They cannot be compared. So to make the statements reliable and comparable, you must follow these accounting principles. Now one by one I will discuss all these rules. They're very easy to understand. First of all, separate business entity concept, or this is also called separate accounting entity concept. According to this concept, the firm and the owner of the firm, they are treated as two separate entities, right? So while writing the books of accounts, you look at every transaction from the perspective of the business and not from the perspective of businessman. Reason for this is simple, because if you mix the transactions of both business and businessman, then you really cannot find out the correct profit or loss made by the firm, or even you cannot know its financial position as at the end of the year properly, because you are mixing the transactions of businessman and business. I will give you an example. For example, if I invest some money in a business, if I start a business, right? So I want to know the profit made by this firm. Now if my accountant puts the interest received by me on my personal investments in the firm's books, right? If I receive rent from my personal building in the accounts of business, then naturally the profits of the business will be inflated. Though these incomes, they are my personal incomes, they are not the incomes generated by my business. Hence they should not be mixed. That's why I say this concept says that business and the businessman should be kept aside. They should be, kept separate. They are two separate entities. Okay? Due to this reason only, when a businessman introduces capital in the business, then liability of the business toward businessman increases. Similarly, when a businessman withdraws money from the business, his capital reduces. That is, the liability of the business towards businessman reduces. Okay. So due to this principle, we are able to calculate the proper profits of the business and also are able to find out the financial position of the business properly. Okay. So in a nutshell, I can say, while recording every transaction of the business, you should keep in mind that you have to view every transaction from the angle of business and not businessman. It is clear? Okay. Now we move on to the next concept. This is money measurement concept. Okay. According to this concept, all the transactions in a business, only those transactions in a business can be recorded which can be measured in terms of money. This means only those transactions which can be measured in terms of money can be recorded. It also means that those transactions which cannot really be recorded in terms of money will not be recorded. For example, you have a very efficient manager. Now this is a very useful thing for the business. It contributes to your profits, but you really cannot show it in the books. Okay? Your company has a good reputation in the market. Right? Now it is a fact which enhances your business and which enhances your profits. But this thing again cannot be recorded in the books. So only those transactions which can be represented in terms of money will be recorded. Second is that all the transactions will be recorded only in money terms. That means they will not be recorded in their physical units. For example, you have your factory in 10 hectares worth 2 crores. So what will be recorded? Land at 2 crores and not 16 acres. What is the reason? Because if you write 16 acres, you record it as 16 acres. Then, if you have, say machinery for 5 lakhs, but 2 pieces, and you say 2 pieces of machine, particular machine, can you really sum up them to a single unit? No. So if you have to total them, if you want to know the total invested in a business, you have to record every transactions in the rupee terms or in terms of money. You cannot record them in their physical units. Okay? So this is the concept, money measurement concept, which says that you can record only those transactions in the books which can be represented by money or which can be measured in terms of money. Okay? Then we move on to the next. This is going concern concept. According to this concept, while writing the books of accounts, we assume that the business will go on endlessly or for a very, very long foreseeable period. This means, in other words, that we don't have any intention or the necessity to close down the business. This is one aspect. Second is that we assume while writing the books of accounts that this business will continuously go on at this level or maybe higher level, but it will not come down substantially. Why we think so? Why we assume so? Reason for this is that if we don't assume this, then every expenditure which we incur will be treated as revenue expenditure. That means if we don't know whether we will be continuing this business tomorrow or not, naturally whatever expenditure we make, we will like to deduct that from the revenue of this year only, or you can say in other words, we will debit every expenditure in this year's profit and loss account, right? Which may not be correct, because any asset which you buy is actually a bundle of services which gives you service over a period of time, and naturally you should subtract from the revenue of that year only that much amount of services which you have derived from that asset. Okay, so this is the principle, one concern concept, which really helps us in differentiating between capital assets and expenses, right? Because we are able to depreciate a machinery over a period of time only in the hope that this business will continue for a very, very long period of time, foreseeable period of time. Okay? Otherwise, we have to debit every expenditure in the same year in which we incur. So, this is the concept behind differentiation between revenue and capital expenditure. Am I clear about it? Okay. Now we move on to the next concept, which is accounting period concept. We want to know the profits made by a firm, or we want to know the position, financial position of a firm from time to time. Why we need this information? Various users of accounting information need this to take decisions. Managers, owners, creditors, lenders, all have to take certain decisions relating to the firm, and for this they require this accounting information from time to time, right? For this, normally a period of 12 years is considered sufficient, that a period of 12 years is sufficient enough to even out the ups and downs in a business, right? So we find out the profits or loss made by a business for a period of 12 months, which is considered or which is called accounting period. The period for which we make our accounts is called accounting period, and generally it is a period of 12 months. Okay. Normally financial period or financial accounting period is from 1st April of this year to the 31st March of next year, and some people also follow the calendar year from 1st January to 31st March. If we were to really find out the exact profit made by a firm, then we will have to wait for its closure and sell all the assets and pay off all the liabilities, and whatever is left in our hands, we have to compare this amount with the amount which we initially used for starting this business. The difference will tell us the exact amount of profit, right? But what is the use of finding out that profit if we now cannot take any decision on that basis, right? So this is the reason we have divided the period of accounting into smaller periods of 1 year. So we prepare our books of accounts or financial statements for a period of 1 year, 12 months, and that is called accounting period. Okay. So this was accounting period concept. Now I will talk about cost concept. According to cost concept, we have to record all the assets in the books of accounts at cost price, at their purchase price. Now, what is the purchase price? Purchase price includes the cost of acquisition, right? And other expenses incurred to bring the asset to the premises and to make it functional. So this means if we have spent some freight, etc., to bring it to our premises, that will be added to the cost of the asset, right? And then if we have paid some insurance, it will be added. And if we have paid some installation charges, they will also be added to the cost of purchase. So this will become your cost at which the asset will be recorded in the books, and year after year it will be shown at this rate only, at this price only in the books. But only difference will be that figure, that cost will be adjusted for depreciation every year. Whatever amount of depreciation you charge, it will be subtracted from that cost, and then it will be shown in the balance sheet. Right? This is also called historical cost concept, that because this is actually the historical cost which we have actually spent. It is not replacement cost. Maybe if you have bought a machinery for say 1 crore, it will be year after year shown at 1 crore less depreciation charge. But maybe its replacement cost afterwards is 1.5 crores. It could be. So, but we always show this at the price at which we bought it plus expenses incurred with relation to this. Why we do this? This keeps objectivity in place. Because if we try to put this figure at replacement value, then what will happen? I say this machine is worth 1,10,000, though we bought it for 1 lakh. We bought it cheap. But somebody may say I can buy it for 90,000 only. So objectivity will be lost. So whatever we have actually paid for this machine should be shown in the books. So this is the cost concept. Okay. Now I will talk about dual aspect concept. This is the basics of our double entry bookkeeping system. Right? This concept says that every transaction has 2 aspects to it, and while recording in the books, we must record both the aspects. For example, If a businessman invests in a firm, now what are the two aspects of this transaction? First of all, cash with the firm increases. This is one aspect. Second aspect is that firm's liability towards the owner has increased by the similar amount. So this concept says that both the aspects should be recorded in the books. So this is basically the concept behind double entry bookkeeping system. And this can also be represented in the form of accounting equation where it is stated assets is equal to liabilities plus capital. This equation always remains equal. That's why we call it equation. This is because whenever asset side will increase, definitely liability side will also increase. If asset side decreases, then liability side will also decrease. And if they remain same, then one asset will increase, the other will decrease. For example, when you buy machinery and pay cash for this, your machinery is increasing, cash is decreasing, so your assets remain same, so liabilities is not changed at all. So accounting equation remains same, right? So this is dual aspect concept. Next is revenue recognition concept. Revenue recognition concept states that we must recognize a revenue only when it is realized. Only when it is realized. Now there are two things to it. First of all, what is revenue? Second, when it is realized. Revenue is any inflow of cash which is because of our sale of goods, or any cash inflow which is because others have used resources of our business. For example, if we have extra space in our factory and we have rented it out and we receive rent, this cash inflow is because of usage of others by our resources, that is our premises. Similarly, if we earn interest on our fixed deposits with the bank, this is again because of our resources. This cash inflow is because of our resources. So these are revenues. So when they should be recognized, this is the main point. The revenue should be recognized at that point when we are legally, rightfully entitled to receive it. That means the moment we become entitled to receive it, right, we shall recognize it. Now, whenever we sell goods to others on, say, credit, so the moment ownership of the goods change hands, the moment the other party becomes the owner of them, that is the time we become legally, rightfully entitled to receive money against those goods. This is the point when we shall record that in our books. Similarly, in case of rent, etc., which are, you can say time incomes, they should be recorded with respect to time. For example, if interest for the period ending March 31st has not been received by us, but it has become due, it shall be recorded in books because it has already accrued to us, though not received by us, because we are legally entitled to receive it. Similarly, if rent has not been received for any month, right, but our tenant has used our premises, he was legally in occupation of that premises, we are entitled to receive payment for that. So that should be recognized with passage of time. Correct? So this is revenue recognition concept. Okay? Now matching concept. This is a very interesting concept. This concept says that if you are to find out proper profits, you must match or subtract from the revenue of an accounting period the expenses incurred to earn that revenue. Okay, I repeat it. According to matching concept, you must match the expenses incurred in a particular accounting period from the revenue of that accounting period. If, for example, you have recognized a particular amount of revenue in a particular accounting period. Now, whatever expenses have been incurred to earn that revenue should be subtracted from this. This is in a nutshell matching concept. Due to this only, we subtract from the sales of any particular year only the amount of cost of goods sold, not the amount of goods purchased. For example, we bought goods worth 1 lakh, but out of that only goods worth 80,000 are sold for say 1,50,000. So our profit shall be 1,50,000 minus 80,000, because that is the amount of goods sold for 1,50,000, and the goods remaining with us worth 20,000 will be treated as an asset closing stock, right? Similarly, the expenses which are spent in that period, for example, rent paid, salaries paid, electricity bill paid, which are for that time period, should also be deducted from the revenue of that period, right? Like depreciation. Now depreciation is charged at the end of the year, and this is for that particular period only in which that revenue has been earned. So this shall also be subtracted from the revenue of that year only. So in nutshell, according to matching concept, you shall subtract from the revenue of a year cost of goods sold and all the expenses which pertain to that accounting period. If you do this, only then you will be able to find out proper profit or loss made by the firm in that accounting period. This is actually matching concept. Clear? Now, full disclosure concept. According to this concept, that you must disclose all the information, all the financial information pertaining to the performance of the firm, that is financial performance of the firm, which could affect any reasonable investor in taking an informed decision. So, while writing the books of accounts, you must disclose all the relevant information properly, either through the accounts or through the notes to the accounts. For example, if you have stood surety or a guarantor to anyone, now this fact must be stated in notes, that if we have stood surety for this person and if he does not pay the amount, right, then we will become liable to pay this amount, and this is the amount. So this is full disclosure principle, due to which we do so. So according to this principle, all those information which are relevant for anyone to take informed decision should be disclosed, either in accounts or to the notes to the accounts. Okay? Then consistency concept. According to this concept, to keep the financial statements reliable and comparable from year to year basis, and also with others in the same industry, we must follow the accounting policies consistently. It means that, for example, if you are using a particular method of charging depreciation, it should be followed continuously from year to year. It should not be changed midway. Similarly, maybe inventory you are valuing in a particular way. It should be pursued consistently so that your results are not affected. So this is said by consistency concept. But let me tell you one thing, this does not mean that you cannot change your accounting policies ever. No, well, you can do so if required by any law of land, or if you feel that okay, our books or our accounts will show better position in the sense that they will depict the financial position like in a better manner, right? It will be more understandable. Then you must change it, right? Then you must change it, and if you change it, then you should also disclose, according to this concept, full disclosure concept, that you have changed this policy and how much is its effect on the profits of this year. For example, if you have changed the method of charging depreciation, and due to this you have charged depreciation 10,000 more in a particular year, you must say that we have changed from this method to this method, and due to this we have charged depreciation rupees 10,000 more, and due to this our profits are shown 10,000 less as compared to the profits which would have been shown if we would have followed the earlier method. Okay, so this is consistency concept. These concepts are very much related. According to consistency concept, you must follow the accounting policies consistently. But in case you make any change, you must calculate its impact on profits and must disclose as desired by full disclosure concept. Clear? Okay. Now, materiality concept. You see, all through I have been saying that to keep our books of accounts or financial statements reliable and comparable, we must follow these principles or concepts in a full manner. I mean, in totality, we must follow these principles. But this concept says, materiality concept says that you must, though you must follow all these principles, but you should not go to the extent that you go on showing or depicting all those information which is not really very much useful for users of the accounting information, which may make it cumbersome or even cost effective. It may not remain cost effective. Your books may become too bulky, and you may not be able to find out the actual information you want. For example, if we buy stationery and we may not use the whole amount of stationery in that particular year, so if we follow the principles, then the part of stationery which we have not used during this year should be treated as closing stock. But again, this will amount to too much of labor and too much of making our books intricate, tough to understand, but we will not gain much. And if, for example, some amount of stationery is treated as expense of the year in which they are bought, it will not impact much the profit shown by our books. It will not impact much. So according to this concept, if this is not too material, then you should not go behind these principles and show them in a particular manner only as desired by these principles. So in a way, this principle gives you a chance to make exceptions to certain things if you feel that a thing is not that material. Now, what is material depends on the nature of the expense and also on its amount. For example, for a small firm, an amount of rupees 10,000 an amount of 10,000 may also be very material. So you need to show it separately. But for a big firm, an amount of 10,000 may be a small amount and you need not make a separate account for that. You could club it with smaller other items and make it a miscellaneous account. Okay, so according to this concept, you must keep in mind materiality of the transaction while recording it, whether it is really material to put it in a particular manner, whether it will really impact the profits shown by the firm. So if it is not so, then you must see to it that the labor spent on keeping all these principles should be in it should be reasonable. You should not be laboring too much or spending too much money on following these principles if the transaction is not all that material. Okay, then objectivity concept. According to this concept, that you must record the transactions according to the verifiable evidence. If you don't have any verifiable proof of any transaction, you should not be recording it in the books. Reason for this is that then the bias of the accountant will come in the books. For example, if you have bought a machinery and you don't have an evidence whether you have actually paid for it or whether somebody has gifted it, then there is a chance that you may record it in your books or not. And even if you record it, you may record at the price you wish. So it means what? Then objectivity will be suffering in this manner, because then biasness of the accountant will come in. It is his judgment at what figure he takes it. So that's why, according to this concept, the accountant must use the verifiable value which is given in the documents to write or record the transaction in the books, right? And this is easily verifiable from the documents. For example, if you buy a machinery, you can really find out its value from the purchase documents you have with you, the bill you have with you. Use only that figure and not any other figure. This is the objectivity concept, right? So now we will be discussing the principle of conservatism or prudence concept. So according to this concept, you must play safe. You must play safe means that while recording or while recognizing the incomes, revenues, you must recognize them only when they are realized. If there is slightest doubt of you are not being able to realize them, you should not recognize them. Okay? But at the same time, in case of all losses, even if there is a remote chance of happening them, record them in your books. Why we do this? Because if you recognize some income, but if it does not materialize, it will enhance your profits unnecessarily, and because of that you will make drawings, and this will lead to depletion of your capital over a period of time, right? But similarly, in case you don't recognize the losses, though which are remote or which may or may not happen, if you don't recognize them and they actually happen, what will happen? That you have overdrawn from your capital, but actually you are not having that much income. So it is always good that you play safe and recognize your incomes only when they are realized, and record all your expenses even if you have slightest doubt of their happening. Sometimes it may lead to secret reserves, that you are suppressing your income, but you should not be knowingly or intentionally doing it, but no harm in playing safe. So this is principle of prudence. Due to this only, you while evaluating your inventory, you value them at cost price or market price, whichever is less, right? Because if market price of your inventory has reduced, you want to keep it at reduced value, so that if there is a loss, you want to book it, right? Similarly, if you are doubtful of getting back some money from your debtors, you create a provision for that, provision for bad debts. This is also because of this prudence concept. Okay, so this is a very important concept, and every accountant should use it practically. I hope all these concepts are clear to you. Thank you so much.